It's probably not surprising that when we crunched the numbers, we discovered that the three big credit bureaus have been the subject of the most complaints to the CFPB since the start of last year. And they may say that sometimes they receive inaccurate data from creditors so the mistakes don't originate with them. But if that's true, their method for resolving those problems clearly needs to be better.
Approximately 1/3 of Americans have not so good credit scores.
All new at 10, fixing credit report mistakes. 1 in 20 people have the wrong information listed, and it could cost you big bucks.
A new government study to be released tomorrow indicates as many as 40 million Americans have a mistake on their credit report.
It showed us exactly how much common credit mistakes can mangle your score.
25% of credit reports had errors serious enough to deny you credit.
A new study finds a staggering number of credit reports contain mistakes.
A new study says credit reports frequently have errors that can be very costly for consumers.
A survey by the U.S. Public Interest Research Group found nearly 1/3 of all credit reports contain serious errors.
Us know that a bad credit score can prevent us from getting a loan.
You don't have to spend long preparing a broadcast about credit agencies before you learn one simple truth. Everyone, and I mean everyone, has a horror story.
What's up, everybody? How are you? My name is Tony Badri, and we are the credit repair guys that actually kick the collection companies in the teeth.
Before we dive in to the 7 strategies to increase your credit score by 100 points or more, I think it's important that we cover how exactly credit scoring works so that you understand how these strategies are going to help your credit score. There are 2 major types of credit scores used in the United States, FICO and VantageScore. And for today's discussion, we're going to be focusing on FICO, which stands for the Fair Isaac Corporation, because FICO scores are used in around 80 to 85% of all credit decisions, whether that's mortgages, auto loans, applying for a credit card, applying for an apartment, car insurance, business loans where you're guaranteeing them, and so on. Now, there are about 28 different types of FICO scores, but the 5 factors we're covering right now are generally applicable for all of them. And by the way, everything that we're talking about in here, if you refer to the credit book that we sent you, this is all detailed in pages 8 to 16, so feel free to follow along in there. Now, the first factor that impacts or that determines your FICO score, and the biggest factor, is your payment history. Payment history counts for 35% of your FICO score. And in a nutshell, payment history measures whether you consistently pay bills on time. And the reason why this is such a big deal is because FICO is designed to measure the chances of you going 90 days or more late on an account. So payment history looks at any time that you paid 30 or more days late on, let's say, a credit card, an auto loan, a mortgage, student loans. It also looks at negative credit items like collections, charge-offs, repossessions if you're talking about an auto loan, foreclosures of a home, tax liens or judgments if you had tax issues or if you were sued in court. All of these are factors within your payment history. And if you had a really good FICO score, let's say a 750 or higher, one 30-day late payment could reduce that credit score by between 70 to 100 points. And a collection or a foreclosure or a repossession could drop your score by as much as 200 points. Now, if you don't have as good credit, then the impact of a collection or an auto repo is a little bit less, but it still is quite large. And so the number one thing to understand when it comes to payment history is you want to be paying bills on time. Now, that's easier said than done. Things come up in life, and that's probably why your credit may be damaged. Fortunately, there is a process to remove these negative items from credit reports. That's what we call credit repair, and we'll be going over that in a little bit. Factor number 2, which counts for 30% of your FICO score, is your debt, or we call it debt utilization. Now, there's 2 aspects to this. First, if you have credit cards, This part of FICO considers how much of the balance on those credit cards you are using. Ideally, you want to be using below 30% of the balance. Even better, if you can stay between 1% to 5% of the balance on each credit card, you don't spend more than that, that really helps your FICO score. And again, we'll go over that a little bit more in a couple of minutes. Now, the other part of this debt utilization factor is installment loans, where you borrow a fixed amount. So student loans, mortgages, if you go buy a car, an auto loan, things of that nature. Now, these loans don't have quite as much impact on your debt utilization or your debt score. So if you just went and bought a house and you owe a lot of money on it, it does affect you, but not as much as having high credit card balances. And you'll find that as you pay loans down over time, it will help your score. But the fastest way to improve your debt score is to pay down credit card balances and not spend as much. The third factor, which counts for 15% of your FICO score, is the average age of your credit accounts. And to put it very simply, the longer that you've had credit accounts open, the better. Okay? So if you have a credit card that's been open for 2 years and you have a credit card that's been open for 10 years, that oldest account, the newer one is helping you, but the oldest account is really helping your score. And if you look at folks who have a FICO score of 800 or higher, they tend to have an average age of credit accounts of around 12 to 13 years. So they've been using credit for quite a while and keeping credit accounts open. Now, it is important to understand when you close a credit account, whether it's closing a credit card or paying off, say, a house loan, a mortgage loan, that account will stay on your credit reports for 7 to 10 years after you close the account. So it's not like these accounts disappear and hurt the average age of accounts part of your FICO score. They do stay on there. But with that said, if you can keep accounts open for longer, that's always better. Factor number 4, which counts for 10% of your credit score, is the mix of credit that you have. So what this means is having different types of credit accounts. So let's say that you have a couple of credit cards. If you also have a student loan or a mortgage loan or maybe a credit builder loan, having that mix will give a boost to your FICO score. By the same token, if all you have are student loans, then also opening a credit card will again help the mix of credit. And the reason why this matters is that FICO wants to test that you're able to effectively manage different types of credit. And you can have good credit even if you just only have student loans or you only have a credit card. But folks who have those really good credit scores and get the best rates and terms, so over a 750, over an 800, they tend to have a nice mix of credit accounts. Factor number 5 is new credit or credit inquiries. And basically what this refers to is applying for new credit. So if you go online and you apply for a credit card, or you go to the bank and you apply for a mortgage loan, those inquiries, we call them, those pulls of your credit do impact your credit score. Now there's 2 types of credit inquiries, okay, when you apply for credit. There's hard inquiries, which is when you go to a lender and you fill out an application and you authorize them to pull your credit. That's a hard inquiry that affects your credit score. There are also what we call soft pulls. That's when you check your credit score on Credit Karma or somewhere else. That does not impact your credit score. That's when you get those promotional offers in the mail telling you to sign up for this new credit card or this new card from Macy's or Nordstrom's. Those are promotional offers. They do get listed on your credit report, but they do not impact your credit score. Now, it's also important to understand how credit inquiries, when you're applying for a loan, how they affect you. Okay? If you're shopping for a mortgage or an auto loan, then all inquiries within a 14-day period, as we explained in the book, they all count as a single inquiry. So if you choose to apply for with 10 different mortgage companies on the same day, or you go to the auto dealer and they pull your credit for 8 different lenders, all of those are going to count as a single inquiry. They're not going to impact your score 8 different times or 10 different times. So it is possible to shop around for the best rates without damaging your credit. So now that you understand the FICO factors, Tony's going to share with you a very powerful strategy that we advise clients to implement very often. That's authorized user status.
Thank you, Shiva. And boy, do I have a special hack for you guys, right? It is my personal favorite technique to help boost credit scores literally overnight. It is something that we have been using here on the mortgage side for many years to help our clients kind of get up to that next tier, right? So it's referred to many times as piggybacking or coattailing. The idea essentially is to what? Is to be able to tap into somebody else's seasoned and established credit. So the mechanism on the credit scoring side is called authorized user. Now, authorized user is when you are added to someone else's credit card just to be able to use their card, not as a co-borrower, not as a co-signer. Authorized user. So let me give you an example of how this works, because parents have been using it to help their children build credit scores really quickly and overnight and without any hassle or any risk. Okay, these are really two important things, and also legal. Now, let's say that you have a friend or a family member that you know he or she has well-established credit. So how do you tap into that? So you say, guys, let's say in my example is Shiva, right? I've known him. He's someone who has really strong credit, someone who is financially responsible, and he has an American Express card that he's had for well over 10 years. So if I want to tap into that good history that he has built, I say, Shiva, I want you to add me as an authorized user. But Shiva might be concerned about it, and not just that. He might say, hey, Tony, you know what? I don't mind helping you build your credit, but I don't want to give you access, necessarily access to my funds. So how do we protect him while we create a win-win situation for everybody? So I give him my personal information, like my name, my social, my date of birth. He picks up the phone and he calls up American Express and he says, I want to add Tony as an authorized user to my card. So when that happens, a card in my name will come in the mail. Now, that card does not have to go to me. So to protect Shiva and to help me tap into his good credit history, that is, he can simply keep or cut the card. All I want is what is the good credit that he has built for the last 10 years to be copied from his credit report and pasted onto mine, skyrocketing my credit scores literally overnight, and it can do the same for you. And it's a great way to also boost your credit and avoid all of the scams and the traps and all of the little weird things we hear about, like trade lines online all the time, which are essentially sometimes, are often enough, are authorized users, but they're disguised as primary borrower trade lines, which is absolutely not the case. Matter of fact, they are illegal, quite frankly. So avoid all the hassle, avoid all the trap. Reach to someone like a family member or a trusted friend and say, hey, you know what? I want you to help me build or rebuild or boost my credit score by adding me as an authorized user. Explain to them exactly the details, how it's going to benefit you, and also provide protection for them, and everybody win. So with that being said, add yourself as an authorized user to someone established credit today. Avoid the hassles and paying for questionable trade lines, and watch your credit scores skyrocket literally overnight. And stay tuned. Shiva got some more great tips for you guys.
Thank you, Tony. Authorized user status is one of the simplest and most powerful credit strategies out there, so make use of it. Our second credit tip is what we call the 30% rule. And I touched upon this earlier when we were talking about FICO scores. Basically, you want to make sure that as of the date when you're spending, also known as your balance, on your credit card, the date that it's reported or sent to the credit bureaus, you want to make sure that as of that date, it's below 30% of the card's limit, ideally below 10% of the card's limit. Now, I know that was a mouthful, so let me break it down for you. Let's take my credit card, okay? I have a credit card with Chase. Now let's say that credit card has a $1,000 limit. You want to make, or I want to make sure that as of the date when that balance from Chase is sent to the credit bureaus, I want to make sure that balance is below 30% of $1,000, ideally below 10%. So I want to make sure it's below $300, or even better, below $100. How do we do this? there's a few dates you need to understand, okay? So again, the card has a $1,000 limit. Let's say that I spent $100, okay? I spent $100 in the month of January. So I spend the $100, and then my due date on the card is on the 2nd of the month. So February 2nd is the due date. If I want to avoid paying any interest on the card, I would pay off the entire $100 on that date, on February 2nd. Then you fast forward about a week, about 8-9 days, to February 10th. On that date, Chase is going to prepare what's called a statement on the card, which indicates basically what the spending on the card was in the previous month or to date. And they basically are letting you know what you've been spending on. You can check if there were any incorrect transactions, things like that. But what's really important is around the time when your statement is generated, a little before or a little bit after, that balance or that spending is what's reported. So again, remember, I paid off the $100 from January on February 2nd, right? Now let's say sometime between February 2nd to about February 10th when the statement comes out, February 11th, let's say that I again spent $100 in that 9-day period. That $100 balance is what would appear on my credit reports. Now let's say that I spent nothing between February 2nd to around whenever my statement is prepared. If I spent $0, then $0 balance, $0 utilization is what will appear on the credit reports. So you want to try to make sure that for every credit card you have, you look at the statement date and that your balance as of that statement date is below 30% of the limit, or even better, below 10%. So if you have 2 cards with a $1,000 balance, each of them, you want to try to make sure that as of the date of your statement, whenever that falls, you're below $100. Now the date of the statement is different for every credit card company, but you want to keep track of that. They do tell you that when you open the account or in the online login, so keep an eye on that and keep those balances low. Now, what if you have credit card debt? So you're saying, maybe you had to spend on a bunch of expenses, you went on a vacation, and it's been hard to pay off, or maybe you're not making as much as you want at work, you had one of your shifts cut, or you went through a divorce, or you've had medical issues, you're out of work, you've got a bunch of credit card debt. How do you get out of that? If you go to page 53 in the book, you'll see a bunch of pretty powerful strategies to pay down credit card debt. I'm going to mention them briefly here. One of them is what we call the debt snowball method. Here, basically, you focus on paying down cards from smallest balance to biggest. So let's say you have one card with a $2,000 balance, another with a $5,000 balance, and you're carrying that balance, that spending every month, you're paying a bunch of interest. You're going to focus on paying down the $2,000 balance first, while on the one with the $5,000 balance, you're just going to make minimum payments. And the one with the smaller balance, the $2,000, right? You're going to either take savings or take money from a second job or a side job, and you'd have to use that to pay off as much as you can. Then when you've paid it off, you work on the card with $5,000, pay that off. And that's a good way to progress through it. The debt avalanche method is pretty similar, except here you're focused on paying off cards in order of interest rate. So the interest rates on credit cards, for those of you who have them, they're really high. If you ever look at your card agreement, it might be 19%, 23%, 24%. They're making a lot of money off of you on these credit cards if you're carrying credit card debt. So you're going to use the debt avalanche method, where basically you pay down the card with the highest interest rate first, take that extra money from savings or from your side hustle, pay that card down. Then once you've done that, pay down the next card with the highest interest rate. So with this strategy, you don't really care about what the balances are, you just care about the interest rate. Another hack, which is also in the book, if you're around page 53, you can get a personal loan. For this one, you need at least OK credit. You need at least a 650 FICO usually. You can get a personal loan and use a personal loan to pay down the credit cards. Now, the reason why this is smart, as I just said, you often have really high interest rates on those credit cards. So let's say you had 19% interest on a credit card, but you can get a personal loan for 12% interest. 12% is obviously less than 19%. So you go pay off that credit card, pay off the card, the full balance, and then you repay the personal loan company at a lower interest rate. So you're saving on interest. This will only work if you already have OK credit, but it is an option if you're in that 650 range. Another one is balance transfer. Again, for this one, you need at least a 650 credit, so you need at least a decent score, maybe just one or two bad things. If that's you, then pay close attention to this one. With balance transfer, you're going to move the entire balance on one card over to another card. So let's say again that I have that card with a $2,000 balance. I would transfer, let's say it's a card with Discover. I would transfer that $2,000 from Discover to a different credit card company, let's say Citi. I would have Citi open a card called a balance transfer card, and I would move that balance over. Now, I won't have to pay any interest to Citi for a period of time, let's say 12 months, up to 18 months. And you can use that time when the clock has basically stopped on the interest. You can use that time to pay down the balance and really save money on interest and improve your credit score. So that's another really good approach. So that's the second tip is, as I said, paying down credit card debt. Now, tip number 3 is if you don't have credit cards that are in good standing, that you know that you've paid on time consistently. If you don't have credit cards, or maybe you have charged off credit cards, you have a lot of lates, you should look into a secured credit card. Now, a secured credit card basically means you're providing the card issuer with a deposit, okay? And that deposit equals your spending limit. So you're sending them some money, let's say $200, and you cannot spend more than $200 on that card. Now you might say, well, Shiva, why should I send them anything? Why do I have to give them money to open an account with them? It's a very fair question. Unfortunately, if you have poor credit, you're seen as a credit risk. So most companies don't want to offer you a credit card. So you're going to reduce that risk for them temporarily by giving them this payment, which you can get back at any time, this deposit, which equals your spending limit. So let's say you send that deposit over $200, okay? What you're going to do next is use this card like a debit card, but with a catch. You're only going to make one purchase each month, okay? So you might just go grab a quick snack or lunch, okay? You might take a little go buy some gas to fill up before a drive. Make a purchase like that, okay? That's the only purchase you make for the entire month. And then before the date when your payment on the card is due, pay off whatever you spent, what we call the balance on that card. So let's say that you spent $20 on gas, okay? Which if you live in LA, you definitely spent more than 20, but let's just say it was $20. You're going to spend that $20 in January, let's say. Now come February, let's say your card is due on February 3rd, you're going to pay off the $20, that was your balance, okay? And now you've paid it off and you're showing a low balance, or you had no balance left, so you didn't have to pay interest, and you're also showing a low balance for FICO scoring purposes. You're following the 30% rule as well. So that on-time payment, where you paid off the balance, where you paid as of the date due or before, that is reported to all 3 credit bureaus. And if you remember, your payment history is the #1 factor in your FICO scores. So you just added an on-time payment to your credit report. Now you do that month 2, month 3, 4, 5, 6. You're adding more on-time payments, your score is going up, okay? Plus you're keeping that spending low. So score is going up, spending is being kept low, using the card responsibly. And secured credit cards are pretty much mandatory for anyone who wants to build better credit and has a credit score, FICO score below 630. Like, you really should consider a secured credit card, along with the authorized user strategy that Tony mentioned. Now, which secured credit cards should you look for? We like Discover and Capital One a lot. The great thing with Discover is they automatically review your account after around 8 months and see if they can upgrade you to an unsecured card. So what does that mean? You opened the account, you gave them $200, they opened the account, you're making that one small purchase a month, you're paying it off. If you've been doing that for about 7 to 8 months, Discover will look at your account and say, okay, you know what? They've been paying the account on time every month. Let's give them back their deposit and keep the account open and give them a higher limit. So they'll send you a check in the mail or credit to your account, $200 back to your checking account, and they'll increase your credit limit to $400 or $500. So now you have a higher credit limit, which is better, and you got back that $200 so you can do whatever you want with it. So it's really great. And Discover also has no annual fee, so that's also fantastic. Capital One is really good as well for a different reason. Remember we said you have to put a deposit. We used the example of $200. Capital One lets you put up smaller deposits. So they might give you a card with a $200 limit, and you only give them a deposit of $50. Again, that deposit is because you have poor credit. But even though you have no credit or bad credit, they're still letting you put up a little bit less than the full spending limit, right? So it's pretty convenient. All you would need is $50 or $100, and you have a higher limit. They don't always do this, but they do pretty often, especially if your score is at least a 540, 550, they'll let you do this. So you have a higher limit without putting all the money and having it tied up. So Capital One is great for that. Both Discover and Capital One have $0 annual fee, so you're not paying money to build credit. As long as you pay off your spending on the card, your balance every month, you're not paying interest, you're not paying fees, and those on-time payments are getting reported to the credit bureaus. Now, if you have a bankruptcy or you have a credit score below about 540, you may want to look at the Visa Open Sky credit card, secured card, because Capital One and Discover often won't approve you. So Open Sky is a good option if your score is below about 540 or you have a bankruptcy. Open Sky does charge an annual fee. It's around $39. But if your credit falls really low, like below that 540, Open Sky is a great option. So that's our third tip. Open a secured credit card and spend as we just discussed. All of this is around page 23 in the book, the secured credit card discussion. So make use of that. And Tony will be sharing some more really powerful credit strategies with you.
Welcome back, you guys, and thank you, Shiva. Building on what Shiva was sharing with you guys is I want to introduce you to credit builder accounts. Now, credit builder accounts are a great way to be able to build more credit history without necessarily having any credit checks or any credit requirement or placing any deposits or any funds to secure a credit card, for example. So equally brilliant is a company called Self.Inc. They used to be called selflender.com, but they recently restructured and they're called simply, and you can find them as self.inc online. And what they do is they provide you with an installment account loan. So it works kind of in a very interesting way. So instead of you having to put up any secured money up front, what they do is they approve you for a loan, but they put the funds to the side. And you get to pay them, when you get to pay that amount over a term of 6 months up to 24 months. So you have the option of 6, 12, 18, and 24 months to pay that amount that you choose. And monthly payments are as little as $25. Now, each month you make a payment to them, and then at the end of the term, they give you the money that you paid back minus some interest and some small fees that they assess for providing you with that service. What ends up happening at the end is that you not just have built credit history, but you've also developed some savings as well too. And it's a very beautiful way to do it. I have personally done it and tested for myself, and it works brilliantly because they do report to all 3 credit bureaus, okay? And taking it a step further, and another thing that we always emphasize folks to do, which is to set up what AutoPay. You can see that in page 50 in the book if you're following along. And if you want to read a little bit more about Self.Inc. in the book, it's on page 30, okay? But going back to AutoPay, AutoPay is about preventing the biggest credit killer, which is late payments, right? So set it up with your bank. For most folks, it's free. For most credit unions, it's absolutely free. Set it up. Incorporate all of your bills so you can avoid missing any payments, because late payments are credit score killers. So AutoPay is a really, really great way to protect you, right? A platform that we use that helps me kind of see all of these different moving parts together is Mint.com. Now, Mint.com is a financial services platform that allows you to manage all of your finances in a single dashboard, including your credit scores, right? So you're able to put in your bank account, you're able to pull in all of your other utilities, your credit cards, your student loans, your mortgages, whatever you might have on credit, and see it all in a unified place. So it shows you exactly where your money is coming from and where your money is going to, and it breaks down how you're spending your money in different categories. And at the heart of Mint is what is AutoPay, because they know that, hey, you know what? Sometimes we get bombarded by so many different things and we forget. Matter of fact, there's been times in where I did not want to set up AutoPay because my money wasn't going to cover every single pay that I need to pay. So I know the feeling, but nonetheless, to minimize the damage and to ensure that fast track towards building great credit, set up your auto pay. You can read more on auto pay on page 50. And in the book, you get a lot more details on page 52 about Mint.com. With that being said, I'm going to tag Shiva back in for more great tips for you guys.
Thank you, Tony. And I hope all of you were taking notes, as those strategies are really powerful and can really help you improve and build and better manage your credit. So I'd like to cover strategy number 7, which is probably what a lot of you signed up to hear more about, which is credit repair, or the removal of negative items from your credit reports. So the first thing you need to understand is that the Fair Credit Reporting Act, which we've mentioned, the FCRA. The FCRA was passed way back in 1970. It's a pretty long law. I've read every word of it, but it is over 100 pages. It says a lot of different things. But for what we're talking about, there's 4 things you need to understand. And those 4 things are the requirements of the FCRA as far as the information, the data that appears on your credit reports. The FCRA says that everything on your credit reports needs to be accurate, complete, verifiable, and timely. Let's take a quick look at each of those. Accurate means every piece of information listed on the credit report needs to be correct. So if you look at accounts on your credit reports, you'll see that there's anywhere from 10 to upwards of 50 pieces of criteria of information for every single account on the report. So the name of the account, the date it was opened, date it was closed, the address of the creditor or the debt collector, the payment history, the payments each month on the account, the balance owed, your monthly payment amount, the type of account, the term, that is how long the account is for or has been open for. All of that information needs to be accurate. It's not enough to say that, you had a debt, it went to collections, and now there's a collection on your credit report. That collection needs to be listed accurately. The same thing is true with charge-offs, with late payments, with foreclosures, auto repossessions. The fact that that event happened to you, that the account belongs to you, is not enough. It has to be accurate. Along those lines, the information also has to be complete. So as mentioned, there's a bunch of different pieces of data on every credit account. You can't have some of those fields blank and others filled in. So you can't say, oh, we don't know the date the account was opened, or we don't know the payment history, but we know that he was late, or we know that she, owes money to a debt collector. The information needs to be complete. All available information on the account needs to be filled in. Next is verifiable. Now, all of the information on the credit reports comes from creditors, debt collectors, and services that provide court records. So a bankruptcy, a judgment, tax lien, those come from public records providers, companies who do that. The stuff about your mortgage, your credit cards, your auto loan, your student loans, those come from, Navient, Chase, Fairway Mortgage, Capital One, all these accounts you have. And also debt collectors. If you have collections on your credit report, the debt collectors send information. All of this information is sent via a software. It's called Metro 2. You don't need to remember that or worry about it, but Metro 2 is the software. That's how they report information. And whatever the collectors or the creditors say, it has to be verifiable. They have to have proof of what they put on your credit reports, proof that all those pieces of information I mentioned, that they're accurate. Last is timely. Most things can't stay on your credit report. Most items cannot remain for more than 7 years and 180 days, 7.5 years. For certain types of bankruptcies, they could remain for 10 years. And it's really common, especially with collections and charged-off accounts, for the accounts to stay longer than 7.5 years. And that's a violation of the law, okay? And it really hurts you. Now you might be saying, okay, so they have to do a bunch of different things. But how common are these errors on credit reports? Very common, actually. So the Federal Trade Commission, the FTC, said a few years back that at least 1 in 5 reports, credit reports, has mistakes on them. So that means at least 40 million Americans are suffering with these errors and incomplete and outdated information on their reports. The CFPB, that's another federal agency, the Bureau of Consumer Financial Protection, they've said pretty much every single year since they started around 2011, the biggest source of complaints they get is about credit reports, not about payday loans or mortgages or student loans, credit reports, okay? And there have been a lot of cases where state attorney generals and others in the government have sued the credit bureaus for these reasons because people are being damaged by information on their credit reports. So there's a very good chance that there's information on your report which may be negative and also might not be verifiable or timely or accurate or complete. So That's clearly a problem. What can you do about it? The good news is Section 611 of the Fair Credit Reporting Act allows you to dispute this information, and it requires the bureaus to reinvestigate it. So you would contact the credit bureaus, ask them to investigate an account, then you would start having them look into specific parts of the account that may have issues. Section 623 of that same law, and these are the two things that I focus a lot in my legal practice and with Tier 1 and in credit repair. Section 623 says that you can also dispute and challenge information with the debt collector or with the creditor, and they have to be able to investigate and provide proof of that information. So basically, the typical strategy that we would use, and there's a variety of them, would be to first contact the credit bureaus regarding an account, then correspond with them, require them to provide information about accuracy and completeness. Then we would also contact the debt collector or the creditor, require them to provide information, and then very often you'll find information does not match between different credit reports. Information does not match between credit reports and what the collector said or what the creditor said, or they didn't comply with the requirements of Metro 2, so they didn't use the Metro 2 computer program properly. There are so many areas where they make mistakes. And it's worth understanding because, as I mentioned, I sue credit bureaus. We take them on in court. There are thousands of lawsuits in the United States every year over credit reporting. So as you can see, this is a major issue, but those two parts of the law allow you to dispute negative information. There's also another law called the Fair Debt Collection Practices Act, and basically it controls debt collectors and places a lot of requirements on them as far as not harassing you, as far as having proof of collections accounts, as far as providing you with that proof, and so on. And whenever you have a collection on your credit reports, in addition to the FCRA, we also applied that other law, the FDCPA, the Fair Debt Collection Practices Act. We applied that law to see if there's other grounds to have collections accounts corrected or removed from your credit report. And if a debt collector is bothering you or not following the law, it's also possible in some cases to sue them over that as well. And that's also something that we do. And the beautiful thing is you don't pay for these lawsuits. The fees are paid, the lawyer fees are paid by the collector, by the creditor, by the credit bureaus, so it doesn't affect you. And if a credit bureau does not properly correct information, there's a variety of options, from suing them to filing complaints with the Federal Trade Commission, with the State Attorney General. Attorney letters are often used, as mentioned. Since I'm an attorney, we'll often contact them directly and remind them of their legal obligations, or we might just sue directly. The point I'm trying to make is it's a pretty complex process, but it really is possible to remove bad accounts or bad information that does not meet legal requirements. Now you might be saying, well, Shiva, I could just go on Credit Karma and dispute these items. That's what you're saying, dispute, right? Or I could use the Section 609 credit books or some of the others on Amazon and elsewhere to get these accounts off. Now I should say, it is your right to dispute these accounts on your own. It is your right to work on your own credit, and you should be working on your credit. But it's important you understand a few things. Disputing online through Credit Karma and elsewhere is not a good idea. Those disputes online are designed for the convenience of the credit bureaus, not for you. You're required to pick from a small set of reasons. Also, the form you sign when you do the dispute says you waive a few of your legal rights, so that's really not good. It's designed for the convenience of credit bureaus. And Section 609 does not say what a lot of folks who are pushing that, a lot of companies who are claiming it's a good strategy, does not say what people think it does. And the reason I'm saying that is we've had clients who've done 609 disputes and it didn't work. And also, beyond just disputing, you need to understand, if you have a collection or a charged off account and you owe money, you're at risk of being sued, and disputing that account may not be a good idea at all. It could actually trigger a lawsuit. So you need to know what to dispute and when and how. And you also need to know, in addition, how to apply those strategies we mentioned and the other 14 strategies in the book to also build better credit while you work on removing bad things and repairing your credit. And we cover all of that in our free credit analysis, the A+ credit analysis, we like to call it. You get your credit report for just $1, and the analysis is completely free. We get on a call with you or a video call or email or however you prefer, and we'll share with you what strategies you need to implement on your own to build better credit. So things like self-lender, things like secured cards, things like student loan rehabilitation, okay, things like debt settlement. We'll talk about all of those things. We'll also talk about the negative items on your credit reports. Which ones should you dispute? Which ones should you leave alone? Should you consider settling them? We'll go through all of that, And that, as I said, that's completely free. You're walking away with a bunch of knowledge about exactly what needs to be done to improve your credit score. And a lot, so many people have done this and found it really useful. I know that sounds like I'm bragging, but it is the truth. I've had the privilege of doing this even for friends and family. It's been very useful for all. And ultimately, in a broader sense, I want you to think about where you really are with your credit. If your credit score is less than stellar, if you don't have a 750 FICO or a 700, and you're on this webinar, you probably need help with your credit. And your credit is holding you back. And I know this personally from not having paid law school student loans and ruined my own credit, which is what brought me on this path of learning these laws and using my legal education and my attorney credentials to help folks and to help myself. I was my first customer, I suppose, and so was Tony. And so the point is, give yourself a chance, okay? Better credit is possible. It can be done. I'm not giving you a motivational speech here, but it's the truth. We've seen so many folks go from credit scores below 500, get way up, or folks who just had one ding on their report and maybe they had okay credit, go from okay to excellent. It is possible to improve your credit because bad credit really does hold you back. I think all of you know, from your car insurance to not being able to buy a house to overpaying for credit cards and for auto loans. It's really just damaging and really stressful to deal with. And there is a better way. It is possible for you to enjoy better credit, better finances, more secure, and ultimately a more secure and a more fulfilling life. And along those lines, I would encourage you, when you walk out of here, when you log off today, start taking action now to improve your credit. Whatever it is, start doing, stop dreaming. Thank you so much for joining us today. It's been an absolute privilege to be able to share this time with you, and thank you for trusting us. Go ahead and sign up for that credit consultation and start implementing these strategies. We look forward to getting to know you and being of service to you in the future, and I wish you all the best in your journey towards better credit, better finances, and a better life. Thank you.